From 1st of July 2026, there are several changes to superannuation limits and thresholds. In this video, we'll cover what's changed and the key superannuation limits and thresholds for the new financial year FY27. Let's get straight into it. Number 1. Superannuation Guarantee Contribution. The Superannuation Guarantee Contribution, or SG contribution, is the compulsory amount your employer must contribute to your super on top of your salary or wages. The superannuation guarantee rate reached its legislated target of 12% on 1st of July 2025, with no further increases currently scheduled. As a result, it remains at 12% for FY27. For example, if you earn $120,000 during FY27, your employer would generally contribute $14,400 to your super, the same amount as in FY26. Number 2. Payday Super. Payday Super is a legislative reform taking effect from 1st of July 2026. It requires your employer to pay your superannuation guarantee contributions at the same time they pay your salary or wages. Your employer will have up to 7 business days to make sure your super reaches your super fund. Previously, your employer only needed to pay super into your super at least every quarter. As an employee, you don't have to do anything differently. Your super will reach your account sooner, start compounding earlier, and it will be easier to identify any missing or unpaid super contributions. If you are a small business owner, Payday Super means you need to update your payroll processes and cash flow management. Late or unpaid super contributions may attract penalties and interest charges. Number 3. Maximum contribution base. The superannuation guarantee rate of 12% does not apply to unlimited income. Instead, employers are only required to pay SG contributions on qualifying earnings up to a certain limit, known as the maximum contribution base. From 1st of July 2026, the maximum contribution base will move from a quarterly limit to an annual limit. For FY27, the maximum contribution base is $270,830. If you're a high-income earner, once your employer has made superannuation guarantee contributions on the first $270,830 of your qualifying earnings, they won't need to make any further SG contributions for the rest of FY27. Number 4. Concessional Contribution Cap. Concessional contributions are contributions made to your super that are taxed at 15% inside your super, which is usually lower than most people's marginal tax rate. Concessional contributions include employer contributions, salary sacrifice contributions, and personal deductible contributions. The combined amount of these contributions counts towards what's called a Concessional Contribution Cap, which sets the maximum amount that can be contributed as pre-tax concessional contributions in any one financial year. The general concessional contribution cap increased from $30,000 to $32,500 from 1st of July 2026. But this is just a general cap. Your personal concessional contribution cap might be higher depending on the next rule. Number 5. Carry forward concessional contributions. If your total super balance is less than $500,000 on 30th of June of the previous financial year, you can contribute more than the general concessional contribution cap by using unused cap amounts from up to 5 previous financial years. This means that if your total super balance on 30th of June 2026 was less than $500,000, then in FY27, you can contribute more than $32,500 by using any unused portions of your concessional cap from 5 previous financial years, which are from FY22 to FY26. Unused cap amounts are applied automatically once you exceed your current year's general cap of $32,500. From there, the oldest available unused cap amounts are carried forward first. In an extreme scenario where someone is eligible and hasn't made any super contributions since FY22, they could make a total of $175,000 in personal contributions in FY27 and claim a tax deduction. That's 6 years worth of concessional contribution caps, 5 years of unused caps plus the current year's cap. For comparison, the maximum in FY26 was $167,500. Depending on individual circumstances, even a less extreme application of this strategy can save a lot of tax for someone with a one-off high-income event, such as selling an investment property. A good way to check your unused concessional contribution cap and total super balance is through MyGov ATO service. Before we move on to more super-related changes, I want to give you a bonus tip. The effective tax-free threshold for FY27 is $22,866. It applies to most Australian tax residents who are not eligible for the seniors and pensioners tax offset. This is a slight uplift from the FY26 threshold of $22,575. The main reason for this increase is a reduction in the tax rate for the second tax bracket from 16% to 15%. If you are planning to use concessional contributions or other strategies to reduce your taxable income to the tax-free threshold, make sure not to aim too low. Many still mistakenly aim for the headline threshold of $18,200. If you're getting value from this video so far, don't forget to like and subscribe. It helps the channel grow more than you might think. Thanks heaps. Now let's move on to the non-concessional contributions. These are contributions made to your super using money you have already paid personal income tax on, such as take-home pay that has been deposited into your bank account. You don't get taxed on concessional contributions inside super, and you cannot claim a tax deduction for them. Each year there is a limit to the non-concessional contributions you can make to your super. The annual limit is known as the General Non-concessional Contribution Cap, which is always 4 times the Concessional Contribution Cap. As the Concessional Contribution Cap increased to $32,500, the Non-concessional Contribution Cap has also increased to $130,000 for FY27. However, if your total super balance was $2.1 million or more on 30th of June 2026, you won't be able to access this cap, meaning you generally cannot make any non-concessional contributions during FY27. Number 7. The bring forward rules. Similar to the carry forward rule for concessional contributions, the bring forward rule for non-concessional contributions allow you to exceed the general cap in a single financial year. But instead of using unused caps from previous years, it works by bringing forward caps from up to 2 future years. This means that in FY27, if an eligible individual's total super balance on 30th of June 2026 is under $1.84 million, they can make a one-off non-concessional contribution of $390,000, with no further non-concessional contributions allowed for the next 2 financial years. This rule can get quite complicated, especially if you have a larger super balance or have triggered the bring forward rule in previous financial years. I'll be making an updated bring forward rule video soon. If that is relevant to you, keep an eye out for that video. Again, a good way to check your history with non-concessional contribution and bring forward arrangement is through MyGov ATO service. Number 8. General Transfer Balance Cap. The transfer balance cap is a lifetime limit on how much you can move from your superannuation accumulation account, where earnings are taxed at 15%, into a retirement phase income stream, such as account-based pension, where earnings are tax-free. From 1st of July 2026, the general transfer balance cap increases from $2 million to $2.1 million. If you start your first retirement phase income stream in FY27, your personal transfer balance cap will match the general cap, which is $2.1 million. But if you have already started a retirement phase income stream in the past and haven't used up your full cap, your personal cap will go up by less than $100,000. That's because your increase is worked out by using proportional indexation. It depends on how much of your cap you have used before. This can get quite technical, so it's worth checking your personal transfer balance cap in MyGov or speaking to a financial advisor if you're unsure where you stand. Number 9. Government Co-contribution. The government co-contribution is a scheme where the Australian government contributes to your super if you meet certain eligibility criteria. In FY27, the maximum benefit remains unchanged at $500 if you make a non-concessional contribution of $1,000 or more, and your income is under $49,293, known as the lower income threshold. The exact co-contribution amount depends on how much you contribute and your income. The government matches contributions at a rate of 50%. The maximum co-contribution of $500 gradually decreases and disappears when your income reaches $64,293, known as a higher income threshold or cutoff point. For FY27, both the lower and upper income thresholds have increased, meaning more people will benefit from the government co-contribution. You can use the Super Co-contribution Calculator on the ATO's website to estimate your co-contribution entitlement and eligibility. Number 10. Division 296 tax, often referred to as the new 3 million and 10 million super tax. This is one of the most significant superannuation changes in recent years. On top of the normal 15% tax on super fund earnings, Division 296 is additional tax on the earnings from the part of your total super balance that sits above the $3 million and $10 million thresholds. I have already made a couple of dedicated videos explaining how Division 296 works and who may be affected. Feel free to check them out for a more detailed explanation. Now that you are up to date with the latest superannuation changes, you might also want to check out the latest age pension rules and thresholds. Otherwise, feel free to check out my superannuation playlist, where I have covered a range of strategies and rules that can help you build a larger super balance and improve your retirement planning. Thanks for watching. I'll see you in another one.